tax efficient investments. This is one of your specialist topics.
Mm-hmm.
Let's have a chat about that.
Let's do it.
Give us an overview of tax efficient investments. What does it mean?
Making the most out of your money without paying tax. It's the crux of it.
Or too much tax.
Or too much tax. Yeah, we're not evading it. We're not doing it illegally, but we're doing it, by the law, but trying to make the most and keep as much of it as we can.
Okay, good stuff. So these are effectively investments you can make that have tax advantages to them.
Exactly. Tax perks. So you either save on tax or you get extra benefits by investing in particular areas.
Okay, perfect. And what are the different types available to your average investor in the UK?
So a key one is an ISA, an individual savings account.
Sure.
So anyone in the UK can have that. Even children have junior ISAs, so they can have them from the day they're born, and you can save up to £9,000 a year into a junior ISA for your children. But it does become theirs when they become 18. So you need to educate them and make sure they're not going to go and blow it all when they turn 18. And adult ISAs, you can pay up to £20,000 a year into those. And the tax benefits with all types of ISAs is you don't pay any tax on them.
Okay.
So it's limited by how much you can pay in each year, but there's no tax on growth, there's no tax on withdrawals, and you can save into the same ISA each tax year if you want to and make that as big a pot as you want to, but there's a limit to how much you can pay in, and it's only £20,000. So that's your best thing for tax efficiency, is that. The next one is a pension. So that has tax benefits because you get a top up from the government when you pay into it. So you have to be comfortable that you're locking your money away for a long time, depending on when you start, because you can't get your money back out till you're in your 50s or 60s, but you get tax relief from the government with your contributions.
Okay.
So if you're paying money in, you get 20% tax relief straight away from the government. And if you pay higher or additional rate tax, you get extra tax relief back on top. So it's a really tax efficient way of investing.
That sounds good. So tell me a little bit more about that tax relief. So you mentioned that currently under legislation, people on basic rate, 20%. Get a 20% uplift contribution to their pension. So tell me a little bit more about how that works and I guess the benefits of investing in a pension over the long term.
Absolutely, yeah. So it assumes the government assumes everyone is a basic rate taxpayer. Okay. So if I were to pay £100 into a pension, I would immediately get that uplifted by £20. So I'd only pay £100, but I'd have £120 go into my pension. And if you do that every month over a long period of time, then the tax relief adds up, obviously. If you're a higher rate taxpayer and you pay 40%, then you can claim an extra 20% back on top of the 20% you already get.
Yes.
And if you're an additional rate taxpayer and you're paying 45% tax, you can get an uplift of an extra 25% on top of the basic rate. But also, even if you don't pay any tax and you're a non-taxpayer, you can still pay up to £2,880 into a pension in a year, and the government will still give you tax relief on it. So even though you're not paying any tax, you're still getting an uplift on your pension contribution. So it can be a fantastic way to invest for the long term. And because you're usually saving for such a long time period, so 20, 30, 40 years, depending on how young you are when you start, the long-term returns can be really, really great, especially if you're investing in higher risk areas, which you can afford to do mostly with pensions because it's such a long time frame. But yeah, with the tax relief on top and the growth you get in a pension, that can be a fantastic way to save for your retirement.
No, fantastic. So what I'm hearing, and I hope what our audience is going to hearing from this, is that, well, the question they should ask themselves is, okay, what other investment could I have where I get an immediate 20% uplift on it, or, immediate 40 or 45%? And just for clarification for the audience, that we're using these figures because that are the current tax thresholds in the UK. If that changes, legislation can change, but that's how things are at the moment in 2025. So
absolutely.
On top of, so we've got pensions and ISAs, how about things like bonds or even like VCTs? If we could just touch on those just kind of broadly.
Yeah, so bonds are tax efficient in a different way as well. So if you've kind of exhausted your ISA allowance in the tax year, and if you've maxed out your pension in a tax year, then bonds can be a great way to invest in a slightly different way. So with bonds, they're internally taxed at 20% with an investment bond. So if you're a basic rate taxpayer, it's already taxed internally at 20%. So if you take any money out, you've kind of already had that 20% taxed. Okay. With a bond, you can basically take out the amount you invest over 20 years. You can take 5% withdrawals if you want to each year with no tax, because it's basically deemed as a return of capital. And if you remain a basic rate taxpayer, you can take above that 5% a year. But as long as it doesn't tip you into a higher rate of tax, then you won't pay any extra tax on the withdrawals. So if you're a basic rate taxpayer, it can be a really efficient way of investing as well. And lots of investment bonds do have very similar options to stocks and shares, ISAs and things like that. So it can be a quite a good way to invest slightly differently, and whilst still giving you decent returns as well over the longer term.
Okay.
And then if you want to get a little bit more complicated, you have things like VCTs, venture capital trusts, and EISs, enterprise investment schemes. They're a little bit more technical, and you definitely need to speak to an advisor if you're going to go down that route. But they can help you if you've got big income tax or capital gains tax bills. They can help you offset or delay some of those tax bills that you possibly don't want to deal with at the time that they arise.
Like, broadly speaking, no technical jargon, like no stats. Give me a quick overview of the different types of tax efficient investments.
Okay, sure. So the whole point of tax efficient investing is to pay less tax. Ultimately, most people want to do that.
Sure.
So it's about keeping more of your money and giving less of it away to HMRC, basically. There are the two key ways of doing that are ISAs, so individual investment accounts, because they're completely tax-free.
Okay.
No tax on money in, no tax on money out, no tax on the growth in an ISA, and you can pay £20,000 in each tax year.
Okay.
So nice and simple, very straightforward. You can go to your local bank and set one up. You can set them up online on your mobile banking. Really straightforward.
Okay.
And you can get your money back out whenever you like.
Good stuff.
Pensions are also very tax efficient. You have to keep your money invested until you retire, so you can't get it back out. You've got to be comfortable with that.
Yeah.
But the government gives you a top up when you put money into your pension. Okay. So you get a nice little bump up when you pay money in. Each contribution that goes in, you get a tax relief on it.
Sure.
And then it can help you build your retirement pot over time.
Amazing. Good stuff. So we got ISAs and pensions there. And are there any other kind of options, so like bonds, like venture capital trusts? Could you just give me just a brief bit of insight into those and what those investment options look like and what they are?
Yeah, so if you want to go a little bit more technical, so bonds are probably your next step up. So they are investment bonds are invested in a similar way to how pensions are. You get tax relief in a way, so you can take 5% of your bond each year out with no tax to pay on it, because it's just called a return of capital. So you're just getting back out what you paid in. And then if you're a basic rate taxpayer, you can essentially take as much as you like out and still no tax to pay on it.
Good stuff.
So that's
good
nice
stuff.
and easy. If you want to get even more technical than that, then you've got venture capital trusts. They are more technical and definitely specialist areas.
Okay.
So I wouldn't go off and do one on those on your own. I would go and speak to an advisor. But they can help you with tax issues, like capital gains tax or income tax. If you've got big bills that you want to, sort out, then they can help you save tax.
Sure. Good stuff. So we've had pensions and ISAs. They seem to be, your safer, more commonly used bet.
Mm-hmm.
And then you've got bonds, which are a good opportunity. But then we're talking like venture capital trusts. So you would say that's more for the high risk investor, or maybe someone that's maximised their available contributions into, and then maybe looking for something else.
Yeah, exactly right. So if you've maxed out your ISA allowance, you've maxed out your pension allowance, you've got a big tax bill from whatever, there are policies like a VCT or EIS that can help you with that tax bill, but that is going to be for the more high net worth client who has big tax bills that they have to pay.
No, that's fair enough. And what would you say are the most common mistakes that retail investors make when seeking to build a tax efficient investment portfolio?
I think it's not knowing the allowances for starters. I mean, or one big thing I see is people think they have to set up a new ISA every tax year, whereas actually you can pay 20,000 in to the same ISA every tax year. You don't have to go off and set up a new one. So then you've just got one ISA pot, whether it's a cash ISA or an investment ISA, that's just growing over time. But I still have clients saying, well, it's a new tax year, I need to go and set up another ISA. I'm like, no, you don't. You can just top up the one you've got. So that's a big thing that I see as well. And also just ISAs, people just aren't using ISAs in general. They've got a lot of cash savings, but then you're starting to pay tax on the interest you get. So having most of your savings in a cash ISA, if you want to keep it as cash, is the best place for it to be. Okay.
And why do you think so many people aren't invested? Do you think it's because people don't know, or do you think it's just like a risk thing?
I think it's a mixture of both. I think people are comfortable with cash, especially the older generation. It's what they know, cash under a mattress and all that sort of thing. So cash products tend to be more popular, certainly with older people. But for investing, there is more of an investing appetite with younger people, and cryptocurrency is also a big topic that a lot of younger people want to talk about. So I think there is more appetite to learn more about it there. And a lot of people go off and do it themselves, not really knowing what they're doing. It's fine if you've got a small amount of money and you want to play the market a bit, but when that starts to get a little bit bigger, it might be time then to go and seek out a professional.